in the heart of your note is what I thought about the most this weekend. And I'm going to go to Lawrence McDonald with a great insight this year. The cash on the sidelines. It's jaw-dropping. When yields come down, do they all exit the money market fund to buy Apple?
I don't think that they all exit the money market fund to buy Apple, but there's an awful lot of yield left in the corporate credit markets, in high yield, even in leveraged loans, maybe in equities that is definitely going to be bought. And you don't need to see all of that money come out of money market funds. I mean, we've had $1 trillion go into retail money market funds this year alone. Right. Just a drop in that bucket is absolutely going to drive spreads tighter.
You are pro in the Bramo world. These are questions Lisa should be asking. I'm going to front run her here right now. Where in the spread market is the thing that identifies a tip point when that money moves?
So one thing that I'm looking for is front-end retail flows. They have been absolutely abysmal in corporate credit this year. Historically, there's a very strong bid for that front end because that's where there's actual yield. But right now, cash is where you get the yield, and you have a very flat yield curve. So why would I go into the front end of corporate credit? But once we start to see those flows start to accelerate, then I think that you have a good forward signal that you're going to have a wholesale bid for kind of duration extension and for spread products.
Have the high yield and investment grade bond markets been insulated by the private credit markets in a sense that the high yield and investment grade are both much better quality and more transparent than the massive world of private credit that has grown up and ballooned and doesn't reset in real time?
It's interesting because you historically don't think of the investors in private credit and these kind of smaller mid-market caps as the same as in the investment grade universe. But you see all this institutional cash going into the world of private credit. And I think that it's interesting that you've seen all of that cash being raised while at the same time you've seen very steady institutional demand for U.S. investment grade with very sticky long end spreads. So that indicates to me that you are actually seeing this kind of tandem bid that's almost a barbell strategy in terms of risk, saying, you know, illiquidity and private credit feels okay for right now if I can add some yield to portfolios, but also I do want that core bid in the long end of the investment grade spread curve.
And let's talk about your year-end spread targets for next year. 350. So I'm just looking at the chart. The Fed starts hiking in spring 2022, and you've got credit spreads going back to spring 2022. Next year. What's behind that? Is that with recession, without recession, with rate cuts, without rate cuts?
So we do expect that there will be rate cuts. We think that the first one will be in March. We expect 4 of them. Now, that effectively is market consensus at this point, but when I was telling clients that in October, people were looking at me like I had multiple heads. So we're sticking with that trade. We're not going to add more rate cuts at this point, and we think that's still kind of this bumpy landing. It's not going to be all Goldilocks. It's not going to be easy, but we do think that there is a path for inflation to continue to come down, for the consumer to soften up a little bit, for the Fed to actually stay in quite restrictive territory with real yields and real policy rates being quite positive, but with credit markets being able to perform quite well in that environment, with the exception of those really lower rated, highly leveraged, triple Cs, leveraged loans. That's where the real pressure in borrowing costs is going to remain.